Have you ever seen a stock just start to take off, you jump in, and then, bam, it immediately reverses? Ugh, that painful moment, that's a failed breakout. Getting the entry and the execution right is, well, it's everything. And today, we're going to break down exactly how the pros do it so you can start spotting these traps before they even have a chance to spring. And that really is the heart of it, isn't it? A breakout can be your golden ticket to a huge win, or it can be an absolutely devastating trap. So the goal here is to give you a clear, repeatable strategy to finally tell the difference. Just look at this chart. This right here, this is the enemy. It's what we call a fake out. You see the price break a key level, everybody gets excited, and they all pile in right there at the top, just seconds before the market pulls the rug out from under them. It's a trap built entirely on emotion. So if we want to beat the trap, we first have to understand why it's so darn tempting in the first place. And that brings us to the psychology of it all. You know, it's the oldest, most frustrating paradox in all of investing, right? We all know the mantra is buy low, sell high. So why on earth do our actions so often do the exact opposite? Well, the answer isn't in some complex spreadsheet. It's in our own heads. There are two incredibly powerful forces at play. First, there's herd mentality, that deep-seated need to follow the crowd. And then there's its close cousin, FOMO, the fear of missing out. When a stock is just rocketing up, logic tends to take a back seat to that gut-wrenching fear of being left behind. And you can see this entire emotional roller coaster laid out right here. It all starts with a little bit of optimism that builds into excitement, and then you hit euphoria. That's the point of maximum financial risk, where everyone feels like a genius and they all buy high. But when the market turns, that euphoria just dissolves into anxiety, which turns into fear, and then finally, panic. That's the bottom, where investors sell low just to make the pain stop. Okay, so that's the problem. Enough about that. Let's get to the solution. To avoid the trap, we need to learn how to spot a high-quality setup before the breakout even happens. The absolute ideal starting point for a powerful breakout is what's known as a ranging market. I want you to think of this as a spring coiling up, getting tighter and tighter. The price isn't really trending up or down, it's just consolidating, moving sideways while buyers and sellers are in a fierce battle for control. And you can see the battle lines here are crystal clear. The price is just bouncing between a floor, which we call support, and a ceiling, which we call resistance. These are the two key levels we absolutely have to watch. And this is the moment we've been waiting for. The breakout. Price just smashes right through that resistance ceiling. Now, this isn't just some random price move. It's a huge signal that the battle is over and the buyers have won. This is our potential green light. But, and this is a big but, not every breakout is created equal. This next part is probably the single most crucial concept for avoiding those nasty fakeouts. You see, the professional trader's edge isn't just spotting the breakout, it's waiting for confirmation. Okay, so the first layer of confirmation comes from the breakout candle itself. A really weak signal might be a tiny little candle or something called a doji that basically shows there's a ton of indecision. The battle's not really over. But a strong signal, oh, that's a big, powerful bullish candle, something like a bullish engulfing pattern. That tells a story of pure, undeniable conviction. Now, the second layer of confirmation is just as important. Like Investopedia says, volume gives us critical clues. You know, a price move without volume is like an engine revving really loud, but the car isn't actually moving. It's just noise. So here's the key takeaway. A breakout on low volume is a major red flag. It suggests there's no real muscle behind the move and it could easily fail. But a breakout that's accompanied by a huge spike in volume, now that's your confirmation. That is the market putting its money where its mouth is. All right, so once you have both the candle and the volume confirmation, it's finally time to act. But pros don't just randomly jump in. No, they execute a clear, predefined plan every single time. And that professional plan has three simple but absolutely non-negotiable parts: a very precise entry point, a protective stop loss, and a clear profit target. So step one is the entry. A pro doesn't get trigger happy the second the price pokes its head above resistance. No way. They wait patiently for that breakout candle to fully close above the line. Once that happens, and only then, do they get in. Next, and maybe most importantly, you set your stop loss. This is your safety net. You place it just below that old resistance line, which should now act as a new floor of support. This way, if the breakout turns out to be a fake out after all, you're automatically taken out with a small, manageable loss. It's your escape hatch, and you planned it in advance. And that brings us to the final piece of the puzzle. This is the concept that truly separates the amateurs from the pros, and it all comes down to managing risk and reward. Professionals live and die by this math. They only take trades where the potential reward is at least 3 times greater than the potential risk. So what does that mean? It means for every single dollar they put on the line with their stop loss, their profit target is set to make $3. Simple as that. And the result of that simple 3-to-1 rule is, well, it's genuinely mind-blowing. Check out this example. Here's a trader who loses on 7 out of 10 trades. That's a 70% failure rate. But because their few wins were 3 times bigger than all those small losses, they still walked away with a net profit. This is the secret right here. You can be wrong most of the time and still be a profitable trader. So the final question I want you to ask yourself is this. When that next breakout happens, are you going to trade a disciplined, confirmed strategy like the one we just covered? Or are you going to trade on pure FOMO and just hope for the best? The choice, as always, is yours.